Hello everyone, my name is Kevin Carlson. I'm a mortgage broker here in Canada and have been since 2004. So as of the taping of this video, that makes 15 years. I thought with that milestone in my career, this would be a good time to look back on the mortgage industry in Canada over the last 15 years and see just how much it's changed. I was speaking with a good friend of mine a few weeks ago that doesn't work in financial services at all, and he was mentioning to me that he keeps hearing that getting mortgages these days is much harder than it used to be. Now, I was a little bit surprised to hear that somebody outside of the financial services industry was aware that mortgage financing is much harder and has gone through some changes over the years. Starting out as a mortgage broker in 2004, the list of lenders that I work with has changed somewhat. I still had the normal lenders that I've always worked with, like Bank of Nova Scotia, TD Canada Trust, First National Financial, and many other lenders that help my A clients with terrific credit and easily provable income. But I also had a list of subprime mortgage lenders that have a vast array of mortgage products that could help almost any client. So when I say subprime, that means not the rate is subprime, but the client is subprime. Clients with previous bankruptcy, foreclosure, collections, and difficult income situations, I pretty much had a mortgage that could help them. I remember statistics being thrown around back then that of all the mortgages in Canada, only about 4% of them were of a subprime nature. Now, our neighbors to the south in the US, they also had a subprime mortgage market, but it was on a much larger scale. I remember hearing numbers back then that of all the mortgages in the US, about 35% or more were of a subprime nature. And those subprime mortgages were structured very differently than the ones we had here. Many of them were ticking time bombs. They would start out at a much lower interest rate and an affordable payment. So after a few years, their mortgage payments and their rate skyrocket. And sometimes their payment would double, triple, or quadruple, putting them in a terrible financial position and often would cause a foreclosure and they would lose their home. In 2007, these subprime mortgages and how they were structured caused the US subprime mortgage crisis and the collapse of their real estate market. There is a long and complicated story as to why this happened. If you want to learn a little bit more about the US mortgage crisis, I recommend watching the documentary Inside Job. More recently, there was a movie released called The Big Short. Now, it's a dramatized account of what happened, and it's certainly entertaining, but it doesn't go into all the details on how much heartache that this actually caused and how many millions of people were affected. One of my colleagues in BC wrote a really good blog post about how the US mortgage crisis can't happen here in Canada. Dustan Woodhouse is the president of the national mortgage brokerage Mortgage Architects. I will link to his blog post down in the description below. It's well worth looking at. So why would the mortgage crisis in the US have any effect on mortgage lending here in Canada? Well, two big things happened. Canada and the rest of the world watched as the US mortgage crisis caused mass foreclosure and massive job loss. Millions of people were put out of their homes and often put out of their jobs. The second thing is, this was not confined to the US. Banks all over the world, including Canada, lost billions. That's right, billions of dollars in the US market crash. Two Canadian banks that posted the biggest losses in this crash were CIBC, lost just over $3 billion, and RBC, Royal Bank of Canada, lost just over $1 billion. Ever since 2007, the Canadian federal government has been taking steps to protect Canadians from this sort of thing happening here. There are two basic entities that regulate the mortgage industry: OSFI, or the Office of the Superintendent of Financial Institutions, and the Canadian federal government Department of Finance. The following timeline, starting in 2008, shows the changes that were brought about by one of these two entities since then. In October of 2008, the maximum amortization of a mortgage was reduced from 40 years down to 35 years. In December of 2009, OSFI brought about a document called E18. It was basically just a best practices outline of the initial parts of stress testing that the banks were to comply to. This document didn't really have any teeth, it was just recommendations. Prior to April of 2010, Canadians were allowed to refinance their homes for up to 95% of their current value. It was at this time that was limited to 90% loan to value. The minimum down payment for the purchase of a rental property was actually decreased from 25% to 20%. Less than a year later, in March of 2011, mortgage refinancing was limited again to 85% of the home's current value. And maximum amortizations is also decreased down to 30 years. July of 2012 was a repeat of 2011. Refinancing was reduced again to where it is today, to no more than 80% of the home's current value. Amortizations are again reduced down to 25 years, which is what they are today. Rules around debt service ratio calculations for mortgages were also tightened at this time. The beginning of 2013 is where stress testing started for people purchasing a home with less than 20% down payment. If you were taking a mortgage with a term of 4 years or less, or you were taking a variable rate mortgage where the payment and the interest rate can fluctuate, then you had to qualify to be able to make the payments if the interest rate was higher than you were actually getting, similar to the stress testing today. I can recall many clients that were forced into taking a 5-year fixed rate mortgage because they didn't qualify under these new stress test rules. 2014 and 2015 saw changes in mortgages behind the scenes, with stricter rules in underwriting and other background requirements. Much more apparent to the public, though, was increases to the mortgage insurance premiums that were being charged to people purchasing a home with less than 20% down payment. There were increases in both years. These costs hit buyers hard, with higher fees being added to their mortgage. In October of 2016, the stress test is expanded. This time it doesn't matter what kind of a mortgage you're getting. You have to demonstrate that you can afford to make the payments at more than 2% higher than the actual rate that you're getting. 2017 was a banner year. No mortgage rule changes. CMHC and the other mortgage insurers increased their fees again. Lastly, on January 1st of 2018, the stress test was then applied to all mortgages. Whether you were putting 20% down or not, you have to demonstrate that you can afford to make the payments at the stress test rate. Not all of these changes that were brought about were in response to the US mortgage crisis. The ramping up of the stress testing and making it more difficult for Canadians to get the mortgages they need were squarely aimed at the Vancouver and Toronto real estate markets. It was widely believed that house prices there were going too high too fast, and this tactic was brought about to cool those markets down. However, this tactic is having a devastating effect on parts of the country that were already experiencing a downturn in real estate, like the province that I live in, Saskatchewan. Allow me to put forward an analogy. Let's say you have a playground full of kids, laughing, playing, having a great time, and 2 of the kids fall off the monkey bars and each of them break their arm. Now, do you send the whole playground full of kids to the hospital to get a cast put on? Well, I wouldn't think so. I firmly believe that the changes that have been brought about in the last 10 years have been for the greater good and for the long-term financial stability of Canadians. However, mortgage rules and regulations aren't going to prevent Canadians from going through foreclosure in the event of a job loss or an illness or other family tragedies. You just can't legislate for that kind of loss. In my opinion, Canada was not headed for a mortgage crisis before 2007. But now, after these mortgage rules and changes, we certainly aren't headed for a mortgage crisis. Canada has always had one of the most reliable and stable banking and financial service industries in the world. Have you ever been turned down for a mortgage? I would invite you to comment below and tell your story and the circumstances around why you were declined. If you live in Canada and you have been recently turned down for a mortgage by your bank, then I might be able to help. So please feel free to contact me through my website. Thank you so much for joining me on my channel today and learning a little bit more about the changes in the mortgage industry over the last 10 years or so. If you found this video enjoyable or helpful, I would encourage you to check out the other videos that I've done previously, and you might find those of help as well. Please also consider subscribing to my channel to be notified when additional videos come out. Thank you so much and have a great day.